I'd like to share with you a comprehensive guide to stock investing, the fantastic level at which many people in the world are scaling the heights in terms of wealth from 0 to billion in a few years has got everyone to keep asking the same question: how is this done possible? Indeed, there are many answers to that single question. People have built and scaled their wealth using different approaches. Nevertheless, if done the right way, investing in stock is one of the most profitable ways to grow your wealth long term while you are occupied with the life activities. Hello everyone, you're welcome to this video edition. My name is Antoaneta and I'm so glad to be here again today. There's a lot of content about general lifestyle and financial freedom in my channel. I hope you subscribe to my channel to have access to other similar content. My Facebook community also needs your likes as well as my Instagram page. Now, investing is the best way to enjoy the fruit of your labor by making your money work on your behalf and compound in the long run. Nevertheless, if not done right, it can be the worst financial experience ever and make you lose a lot of money than you can ever imagine. And in this video, I'll try to simplify a comprehensive guide to the stock market for you. It doesn't matter if you are a beginner who knows nothing about the stock market or you're already an investor. This guide to the stock market will still help you take your investing skills differently. What is a stock financial market? Let's assume you started a business and fortunately your business is doing really well, but you have a challenge. You are not able to expand and maximize the potential of your business to make maximum profit possible. To grow your business more and more and develop new fractions that can bring in massive returns, you require a large capital. Indeed, if you don't want to borrow money, then what can you do? You can put up a part of your company for sale and utilize the funds to expand your business. Nevertheless, you can't sell a part of your business directly through your office. You have to place your firm in a stock market. Oh yes, a stock market is a place where buying and selling of portions of companies takes place. These parts of companies that people buy and sell are called stocks or shares. And many of those stocks people buy and sell are not directly from the company. Instead, they are from those who have bought it during the company's initial public offering, IPO. That is, the first time the company places its stocks for sale in the market and are willing to sell those stocks to profit. Moreover, you cannot go straight towards the stock market. Look for particular company stocks and purchase it. You require the help of an intermediary who holds a relation in the stock market called brokers. These brokers charge you a commission fee for their service. It can either be an actual fee for every trade or a certain proportion of the whole transaction. Fortunately, a reform system was created by two guys in 2013 in America. They made a free broker agency to purchase and sell stocks on your smartphone called Robinhood. Here in UK, we're using Trading 212 or Free Trade or quite a few others. Perhaps you may be wondering, now that you've understood what stock is and how you can purchase one, why do you need to buy stocks? Suppose a Hugo company manufactures and sells gadgets and has 1,000 shares where each stock costs $100. Therefore, the entire worth of the whole company is $100,000. By the following year, Hugo expands, builds more factories, hires more employees, and sells more gadgets. Consequently, the company's entire worth increased to $130. Because the company comprises 1,000 small portions called stocks or shares where each sells for $100, the value of every stock will rise by 30%. Meaning that, assuming you bought a stock at $100 from Hugo last year, that same stock would now be worth $130 today. Of course, you can put it up for sale to make a gain of $30. In other words, while you are buying into the stock market, you are purchasing a portion of businesses called stock or share. And the worth of your share grows with the companies as it expands. Likewise, purchasing a stock also means you possess a part of the company. And this is why they will have to share the profit made with you. This is known as a dividend. You are probably thinking by now that as against saving money, you should invest your money and allow it to grow. You are right, but before you feel too excited, you need additional information. It's one thing to invest in stocks. It's another to know how to make a compounding profit from your investment. The price of a company's stocks is not always equal to its actual value. It is either undervalued, overvalued, or equal to the actual worth of the company. Overvalued stocks rise based on the law of demand and supply and will eventually fall. As a wise investor, you want to purchase shares that correspond to the company's actual worth, or even those of value less, since the price will surely increase in the time to come. Obviously, that is not a simple job. You have to analyze companies, study their financial declaration, judge their business ideas, and decide based on figures and calculations. So, how to analyze stocks? Therefore, so long as you want to become a profitable investor, you have to ascertain in the company's actual value and then compare it to the amount that is traded in the market. If it's undervalued, it is profitable investment. If it's overvalued, it is terrible investment. The question is now how to find the actual value of a company. The most common method is the price to earnings ratio. This means the amount stockholders are ready to pay to get each dollar that this company earns. Let's say Hugo has some of 1,000 shares and they make a sum of $5,000 in profit this year. To determine the earnings per share EPS, you need to divide the total earnings of Hugo by the number of stocks they have. This means that the Hugo earns $5 on each share. Likewise, if the stock costs $50, to know the price to earnings ratio, you divide the price of each stock by the earning per share. And in this case, stockholders are paying $10 on each dollar earned by Hugo. In essence, it will take Hugo 10 years to repay you. Usually, an excellent price to earnings ratio should be between 15 or 20. There is more that actually can be that the company is overvalued. The price to earnings proportion isn't the most precise approach to evaluating a business, but is the easiest way to have a broad idea of a company's performance. Meanwhile, companies may take a new shape and outstrip all professionals' projections. Therefore, to make a wiser forecast, consider other analysis such as the proportion of price to book and discounted cash flow. The price to book ratio means how much a company earns when it auctions all of its assets and repaid its debts. Warren Buffett investing strategies. When you think about the stock market, the first thing that comes into your mind is this complicated world of the stock market where no one seems to understand what is going on clearly. Because whenever things seems to go in the right direction, we end up facing a financial disaster. But unlike everyone else, one gentleman seems to know a secret formula when it comes to investing. Throughout his life, he has rapidly made significant success investing in stocks. Lots of people have regarded him as the best investor ever. And yes, this is Warren Buffett. To better understand how stock investing works, it is incredible that we take a deep look at how this man invests, the type of stock he selects, and other factors that amount to his success. Here are some of those factors. Firstly, Warren Buffett doesn't think of a short time when it comes to investing. He is not concerned about where the company will be in a year or two from now. Instead, he is interested in the company's position in the next 10, 15 years or even more. Determining that long-term success can be very complicated. This is why Buffett looks out for stocks from companies that are simple to analyze, because the easier a business model, the easier it becomes to predict the relevance of the company in 10 years to come. The second features are based on the limitation of the business. Will the customer come again to buy the product? This approach is essential because if the company produces a product that sells just once, they have a limited market. But if it's a product that the customers will keep coming for at one time or the other, that is a good product. And a stock from a company that produces such as is considered for investment. Thirdly, Buffett looks at the brand's strength against its competitor in the market forces when making investment decisions. He pays so much attention to how powerful the brand name before throwing his billions into that company. He understands how big of an influence the brand name will have on the consumer's decision. In fact, if the brand is strong enough, consumers will buy almost anything that company produces. The traits mentioned above are seen in the companies Buffett has invested in. Coca-Cola, for example, has a business model that's very simple to understand. Is like a brand name that surprises all other brands in the drink industry, and their product market is unlimited as consumers will keep coming to buy again and again. We can also perceive these traits in his other investments such as Gillette, Apple, and the candies. Therefore, when you are lost on where to throw your money in the stock market, you should consider those three primary traits. 5 rules to keep in mind before you start investing. Investing in stock has been recognized as a gold mine. This is because just a single opportunity you spotted can make you a billionaire from nothing. But how do we recognize opportunities when it presents itself to take better advantage of the stock investing? We can find a sufficient answer to that in the book Intelligent Investors. Buffett mentioned that this book contributed a more significant part to his psychology of investment. Hence, let's see from the book top 5 rules to keep in mind before and during your investment process. Number 1, understand patterns before you buy any stock. Before you invest in any stock, it is not enough to observe the history of the stock. What is essential is to follow the history of the stock market itself. As an intelligent investor, you should not speculate but rather understand the stock market's history and discover patterns to determine the best investment time. Choose investment strategies that fit you. Number 2. Number 3, don't trust the crowd or the market. The market undervalues typically the stocks of companies that are either temporary and or suffering economic losses. As an intelligent investor, you need to be a realist and stop yourself from following the crowd. Number 4, learn how to analyze stocks. And number 5, know the right time to exit. Stock prices rise and fall in an irregular pattern. So you need to know the best time to sell your stocks and enjoy your profit. The moment you realize that one of the companies in your portfolio is overrated and its stock price is growing without any relation to its actual value, then it's better to sell before it crashes. I'd like to share with you the best investment strategy. There have been a lot of opportunities in the past. There are a lot of options today, and there will be a million other opportunities in the future. How many of them do you have to spot to become a millionaire or billionaire? 5, 10 or 15? No, just one. You have to be right just once, as Warren Buffett said. You don't need to have an opinion on everything. It matters not if you miss all other opportunities. As long as you spot just one and take advantage out of it, you are good. To discover opportunity in the stock market, all you need is to become exceptional in one of them. This will help you to spot opportunities in them and take advantage of them before everyone else. And now, in conclusion, if you want to make the most out of the stock market, you shouldn't try to spot every opportunities out there. You have to be right just once. Remember that. Go for an industry that perfectly understands how it works and its perceived growth in the next 5 years, so that you won't be distracted by the instability of the stock market. Please share and like this video if you found it helpful. Don't forget to also subscribe to my channel to see other similar content, like how you can improve your determination, how to start a small business, and what every business needs to be successful. I would also love you to like my Facebook page or Instagram page and let me know your views in the comments down below. Thanks for all for watching, and I'll see you soon.